So I'm going to ask the audience just to kind of look across kind of sectors and maybe give us a bit of your own guidance in terms of where, and this really is hard to see from here. Give us a bit of guidance on where you think EM equities will be best managed. Do have to kind of step here. Okay, so China.
Brazil is not there.
Yeah, I know, it's not an option.
Wow. So,
That's fine.
so I'm going to skip our second slide of question. We're just going to kind of pop on from there. So if you don't mind kind of popping back to the slide deck, that'd be great. Let's do it around the world a bit. Let's start in Asia and kind of have a conversation a bit about what you're seeing and what you're interested in Asia and kind of how it impacts your portfolio. John, if you don't mind starting us off.
I think that sort of the slide that you just put up really sort of sums it up quite nicely. I think China really is ultimately what drives the majority of emerging markets. It's a heavy determinant in how they, overall perform. Obviously, let's sort of put the coronavirus aside for a moment, but China has, if you look at it sort of monetary policy-wise, it has flip-flopped around. It goes through these boom and bust cycles. But, and I think Mark Yusko touched on it during his presentation as well. This is an area that, you just cannot afford to ignore anymore. If you look, across most sort of multi-asset portfolios, a lot of people haven't, really sort of looked very closely at China for just reason. It's obviously because it's very volatile and that sort of thing. But, I think we've got to a point now where it is so critical just because of, the influence that it has globally in terms of the internet revolution and all that sort of thing, in terms of the commitment of capital towards, technology. If you look at, China's technology or sort of say applications, applications for patents, about 40% of the total market share is done by China. This is double what is that of the US, and it's 4 times that of Japan. They really, this is to quote Napoleon, it's pretty much like it's a sleeping lion, and you don't wake that lion, because when you do, it's going to shake the world, and they really have begun to shake the world. And I personally believe that Trump and the whole trade war thing has just really poked the bear. They are doubling down on their efforts to sort of plug the gaps, to sort of compensate for the gaps they have from an independence perspective. The trade war has obviously been resolved to a degree with the phase 1. I mean, I don't think anybody seriously won that whole truce, but it has allowed Trump to focus on the election and China to really sort of double down on its efforts to ensure its independence. And when it comes to overall portfolio allocation, I think for that reason, one has to make sure that China is part of the overall as part of a balanced portfolio.
So John, can I push you a little bit specifically? I mean, in terms of kind of viewing managers in China and doing diligence and evaluating that a little bit.
Yeah, sure. So obviously the Chinese equity market is incredibly volatile. 86% of it is driven by retail investors. It is very nascent. You look at, obviously they're opening it up tremendously, especially since we saw this last year and the years before with the Stock and Bond Connect. That sort of volatility means you do need to approach it in a risk-controlled fashion. And what we've done is we've scanned the globe in terms of equity managers that access this particular market, and what we settled on was actually a balanced fund. The reason being is that it can create a far more balanced and risk-controlled approach to this very, very volatile market. And what we found is that over the long term, this particular balanced fund has actually outperformed. And the reason being is they've built in sentiment indicators, because with the market being incredibly retail-focused, it's incredibly important that you monitor the flows and sentiment around that. And what they do is they will then pull in the equity exposure or push it out, depending on how sentiment is flowing. And that sentiment is heavily, heavily driven by monetary policy. Monetary policy in China is everything, and obviously fiscal spend. As you know, they've spent an incredible amount from a fiscal perspective, and really that has sort of driven a lot of the growth that we've seen going forward, and of course that affects sentiment massively. And they've been this particular fund that I'm referring to has really offered attractive annualized returns as a result of that. You've obviously, I think, just one thing to point out there though is that sizing is everything. Now, I'm not indicating here that, listen, there's a massive buying opportunity in China, which there is, I think, in the A-share market, in particular now in Hong Kong as well. Especially with the protest action and now the coronavirus, it's created this opportunity. I think sizing is absolutely everything. This is a diversification portion of your portfolio. We're looking for attractive real returns going forward, and diversifying the portfolio at the same time. And this is, I feel, when you look at China, there's no better sort of jurisdiction to actually achieve that, but it's got to be sized appropriately. So we will generally look at it around sort of 5 to 7.5% within a well-diversified portfolio, and it really has added tremendous benefits for us.
Emily, do you mind chiming in and sharing what you were seeing there?
Yeah, so my observation...
And certainly feel free to broaden it out across Asia, too.
Sure. So our observations are very similar to what you've been saying, John. It is, within the equity universe, it's a very significant part of the universe. And so it is something that we have to know and we need to know better going forward. But it's very early stages for the development of the capital markets in China. And as John said, it's extremely volatile. It does not trade on fundamentals. It is very much a retail-driven market. So we approach China with caution. We do have a few investments there. Our view on China has not really changed post-coronavirus or the trade tensions. I look at those two situations as being kind of external shocks that will go back to normal at some point in time, although the jury is still out in terms of what the U.S. policies towards China. I would expect those to get worse, not better. But when we look at China, we think about a market, or we see an economy that is decelerating in terms of its growth pattern. So independent of what's going on now, it's probably decelerating 30 to 50 basis points per annum just over over the next foreseeable future. And that's because its economy is very big. Obviously it's the second largest economy in the world. You can't continue to grow at really astronomical rates. But also their authorities are pursuing a very concerted effort to de-risk their economy, which means to consolidate the economy to get things under control and in balance. And so they're being very careful not to let the economy grow too much. So that's something that is important, I think, to keep in mind. For us, when we think about our portfolio exposure, we've traditionally had much more in India than we have had in China. Right now, though, we have cut back in India because we've been disappointed in what Modi has done in his second term in power. So there's been some reform we were hoping was going to be high on his agenda, but it has not been, and he's pursued some other kind of more political measures instead. But we do believe that the potential in the future for India is great, mostly because of demographics and because the economy will, when it gets back on its feet again, will start growing. And there you also have inflation, which in emerging markets is actually a good thing when it's contained. So you actually see companies being able to grow easily 10, 15% top line, if not more, on a per annum basis because there's just so much potential value creation opportunities there.
So let's talk about Latin America a little bit. And Carla, if you don't mind just kind of taking us through kind of how you think about Latin America.
Sure.
And I can flip back to the slide if you want me to.
Oh, yeah, sure. So in Latin America, for the fixed income credit asset class, we are very constructive in Brazil, and I'm not biased here. If you look at Latin America recently, we have so many political unrest in countries that are considered stable, like Chile, Colombia, Ecuador. If you look at Argentina, obviously, we're not going to talk about it, but it's facing, obviously, challenges, massive challenges. It is a complex situation in terms of macro recovery. If you look at Mexico, also has serious challenges ahead in the macro path. So it seems that we are running out of options, right? So Brazil stands out among its Latin peers. But I wanted to highlight that Brazil is in an upward trend, right? But it's gradual. And I think that's a very key word that we need to keep in mind. It's a gradual upward trend. But it's in the right direction, right? If you look at the GDP last year, we grew like 1.1%. We have a potential to grow 2% this year. We have the lowest Selic rates ever in our history. We have a very stable and benign inflation. We have accomplished a key milestone, which is the pension reform. We have key reforms ahead of us, like tax reform, administrative reform, other reforms. But remember the word gradual, right? It's not going to be tomorrow. It's going to be, eventually it's going to happen, but it's going to take some time. And if you look at the corporate sector, it's in a very good shape, right? The companies have strong balance sheets. They have low leverage. They don't have any liquidity constraints. They don't need CapEx. Actually, they are operating with idle capacity. They have done liability management. So what not to like about Brazil, right? And going to that chart, besides Bolsonaro bad comments, I think BIL stands out, right? So I received this chart from locals this week, just after the rating cuts. And they say, it's a very interesting chart. It's the first time in history that the Selic rates, the interest rates, meet the US BIL dollar FX rates. Sounds poetic, but it's not good, right? The Selic rates going down is really good, but the BIL going up is not good. So when you think about Dilma impeachment, BIL was 418. It's a president impeachment in the country. We are talking about 425. This was like a few days ago. Today's worse, right? I heard that the currency is even weaker. So I think BIL is the question mark, but within the grand scheme of things, well, is great deals, could be Argentina, right? So we are in good shape.